strip away the gold letters for a moment and ask a simple question. What does Donald Trump actually own, and what's just the glow of his name? That gap between hard assets and hype has followed him for nearly 5 decades, and it's shaped not only his fortune, but his public story. To see it clearly, start before the skyscrapers. Donald Trump grew up in a real estate family. His father, Fred, built and held thousands of middle-income apartments in Brooklyn and Queens. Those were real properties with rents and maintenance and mortgages attached, hard assets you could look up in city records. Donald inherited that base and the know-how that came with it, but he set his sights across the East River. In the late 1970s, he made his first major Manhattan play, the decaying Commodore Hotel by Grand Central. He didn't buy it free and clear. He pulled together a complex deal with a tax break from the city, financing from a bank, and a management partner. The Commodore became the Grand Hyatt, and it put his name into the Midtown conversation. The key point is how it was built, through partnerships, loans, and a favorable lease, not by writing a personal check. That pattern would repeat. Trump Tower, opened in 1983, sits at the heart of the verified pile. The land, the structure, and the condo sales produced cash. Over time, he sold many of the condominiums to buyers while keeping the retail and office portions as income-generating property. You can trace that asset on the tax rolls and through loan filings. It has value no matter what you think of the brand. The 1980s were his boom years and also the years when the line between image and income got blurry. He bought the Plaza Hotel. He pushed into Atlantic City with casinos Trump Plaza, Trump Castle, and the Taj Mahal financed heavily by junk bonds and bank loans. He bought a yacht and the Eastern Air Shuttle, renamed it Trump Shuttle. There was a lot of cash flowing, but much of it was borrowed, and many of the assets were bleeding money. They were headline-grabbing trophies more than steady moneymakers. When the economy turned in the early 1990s, the debts came due and the math stopped working. Lenders took control stakes in his casinos. He gave up the yacht and the airline. He lost control of the plaza. Bankers restructured loans to avoid a messy personal bankruptcy because his name, even then, carried value they wanted to preserve. The lesson was harsh. A name can draw attention, but loans get paid with cash flow, not with press clippings. Out of that crisis, he clung to a smaller set of core properties and looked for opportunities with low cash outlay and high visibility. He acquired a long-term ground lease at 40 Wall Street in 1995, poured money into renovations, and turned a half-empty tower into a fuller one. A ground lease means you don't own the dirt. You lease it for decades and own the building's income stream during that term. It's valuable, but it's not the same as owning land in fee simple. That nuance matters when you tally wealth. At the same time, he discovered something that would shape the next 20 years of his finances: selling the brand. Rather than buying and holding every building with his name on it, he licensed the Trump mark to developers who fronted the Capitol. Then came The Apprentice in 2004. The show didn't just pay him a television salary, it shot his brand into millions of homes. That led to a rush of new licensing deals, towers, hotels, golf products, even courses, where the brand could earn without buying the land. It also encouraged a habit of round numbers and glossy claims. In interviews and books, he leaned into the image of a billionaire many times over. Meanwhile, magazines like Forbes tried to pin down a number based on real estate values, debts, and contracts. Their estimates were lower than his public claims, and the gap became part of the storyline. Golf became his signature asset class in the 2010s. He bought or built courses in the US, Scotland, and Ireland. These are real, tangible holdings: land, clubhouses, membership lists. But golf is capital intensive, and many of the clubs reported losses year after year. Some courses appreciate because of location and zoning. Others struggle to break even. As assets, they're hard to value cleanly, especially when the owner is the brand. By the time he launched his presidential run in 2015, he said he was worth more than $10 billion. Journalists and analysts, looking at property records, loan documents, and cash flows, came in far lower. The difference turned on what counts as wealth. A skyscraper you own, less its mortgage, is one thing. A famous name that helps sell condos is another. The first sits on a balance sheet, the second is air until a contract turns it into fees. And that's the heart of the story. Across decades, Trump's fortune has lived in the tension between bricks and branding. The verified core Manhattan commercial space, resort clubs, a handful of hotels and golf courses, rises and falls with the property market and interest rates. The rest is reputation, translated into deals that can be big for a year and gone the next. To understand his wealth, you have to follow both paths at once and keep asking what's owned, what's owed, and what's simply announced.